Welcome to another edition of Around the Table with Stacy Smith. We are midway through the month of March, and investors can only hope the old adage about the weather in March holds true for the economy: in like a lion and out like a lamb. At this point, though, that looks doubtful as the winds seem to be blowing a lot harder. Inflation continues to run at 40-year highs. There is a war that will only put more pressure on the cost of things, and the Fed is faced with a daunting task of trying to rein in inflation without causing a recession. Oh, there's one more thing as well. That would be taxes. So there is a lot to talk about today. And because of all of those things, they could have an impact on how you view your investments and what you should do. And to talk about all of that is my outstanding group of portfolio strategists and analysts, and I would like for you to meet them. I'll start with Frank Rossetti. Frank has been advising clients for 50 years. Frank helped to establish Harvest Financial, where he is the executive chairman. And across the table, we're going to find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a duo background in both finance and software engineering, and you may have seen Kim in her many appearances on CNBC, Fox Business, and on Bloomberg. Also with a seat at the table is a name familiar to a lot of people here in Pittsburgh, Bob Fragasso. Bob has been in the investment business now for 50 years, like Frank, and he's also the chairman and chief executive officer of Fragasso Financial Advisors. One of my regular analysts, Carrie Coghill, could not join us today, so sitting in for Carrie is someone who is well-versed in the field of financial advising, and that is Shana Bielik. Shana is a vice president and financial advisor with Coghill Investment Strategies here in Pittsburgh. So I want to thank all of you once again for joining us, and as I said, we do have a lot to talk about. So I want to start with this, and that's the Fed. It meets this week, and on Wednesday afternoon, it's going to announce its decision on whether to raise interest rates. The Fed chair told Congress 2 weeks ago that he expects the Fed will hike interest rates by 0.25%. Now, that was before the inflation numbers issued last week and the ramifications of the war on the global economy. So my question to each of you is this: how much of a rate hike will we see this week, and how many more are coming, in your opinion? We'll go around the table, and I'll start with Frank.
Prior to the invasion, Stacy, it was widely expected that the Federal Reserve would hike rates 0.5%. But since the Ukraine was attacked, the expectation has been dialed back to about 0.25%. Remember that the purpose of these expected rate bumps is to diminish the demand to reduce the inflation rate. It's interesting to me that this expected move to slow down inflation is being scaled back to a war that is generally believed to be inflationary.
All right.
Stacy, I'll jump in.
Yeah,
I'm thinking about, as Powell had said all along, the Fed will continue to watch the data. And what's interesting is this week, there are 3 key data points that are released before the Fed meeting on Wednesday: the producer price index, retail sales, and existing home sales, all of which may influence their decision making. And of course, as Frank pointed out, the uncertainty about the economic outlook may mean they don't hike as often as people will think.
Bob.
I think the quarter point for sure is already discounted in the current market pricing. The market's expected that for some time. 0.5% could be accepted. But I think it's, as Shana just said, it's going to be the prospective increases that would occur later that would influence market valuations. If there are some nasty surprises, the market will react to it. But what's probably going to happen is already reflected in market pricing.
Kim, do you agree?
I do. And for a little bit of a difference of opinion here, I think Jay Powell, one of his hallmarks of him as a person is he mostly does what he says and says what he does. And that he came out a week ago and said that it was going to be a 0.25 point move. It's going to be a 0.25 point move. I think the Fed has a pretty good handle on the pulse of the economy, and the numbers that are going to be released this week aren't going to be a surprise to them. I don't think they get pre-warned about these. I just think they have a lot of data gathering that goes on. And I also believe that we are not going to get the 7 or 8 increases that some people on Wall Street have been calling for, nor do I believe that that was on the table with Jay Powell, unless inflation was wildly out of control. but he is a steady Eddie Fed chairman, and I'm glad he's at the helm right now.
I'm going to throw this one out to anybody who wants to jump in on it. There's a lot of criticism right now about Powell and the Fed that they are behind the eight ball on this thing, that they didn't act soon enough. Do you guys agree?
I think that the Federal Reserve, they're the experts. They have data that we all see after they see it. And I think they probably were slow to dial back on the stimulus that had been so effective during the downturn. We were coming back and far back from the downturn and probably could have started sooner, and it would have allowed for a pacing.
I think that the Fed really had no control over the thing that caused inflation beginning at the third quarter of last year, and that was ongoing stimulus payments from the government. If you look back at 2010, when the Fed put this playbook first into play by increasing its balance sheet and getting money out to its constituents, which are banks, we didn't have this kind of inflation, right? And that's because it didn't get into people's pockets. Well, because we had a huge flush of money, rightly so in many cases, but probably got that it went on for far too long. The Fed really is behind the curve, but this is a problem not of their making, nor do I strongly believe that it would actually cause inflation to decrease if they would begin a huge ramp up. They would cause other problems.
That was going to be my next question. How much of a balancing act is this for the Fed? In other words, if the Fed acts aggressively, could it push the economy into what is called stagflation, or some people are talking about a recession now? Kim, I'll stay with you on that.
Sure, I think it's really likely if the Fed hikes rates too high too fast, it's going to cause damage to markets, which we're all concerned about. And why is that? Well, it's the discount rate or it's the interest rate that we discount our cash flows. That is at the foundation of valuation. So I think for the Fed head Powell knows this very, very well, that he has to increase the interest rate environment, but do it very well signaled and have few surprises, if any. But I do think he could push us into a recession. And how would that be? Well, it would be mostly through home prices. If mortgage rates increase wildly, right? People aren't going to buy homes. And that is one area that he could really affect that. There's not a whole lot of corporate borrowing going on right now, or personal borrowing really. So you have to really always think Fed, banks, and borrowing. How's that going to affect the economy? And those are the ways that I think he's really cautious. I'd like to hear everybody else what you think.
You also have to consider that there's a number of other things beyond just the stimulus that came out. Due to the pandemic, it seems that we've lost a meaningful number of our employees, and they've determined that they don't need to work. And I don't know if that's accurate. If they're accurate or not, only time will tell that. So we have a reduction of people to produce. So our production is down. So therefore, we don't have the supply we used to have. We have this money that Kim talks about, which did not do anything but increase demand. We also have this energy situation where we now have lost this meaningful amount of energy. We've lost a meaningful amount of wheat production to the world economy, and throw in the trend towards deglobalization, which everyone's trying to pull things in. So we've lost the inflation depressant of cheap products from basically Asia, where labor is a lot lower. And you start adding all this stuff up, and you talk about a balancing act. I think Chairman Powell's sitting on a very small wire, very high in the air, and he's got gale force winds blowing around him to execute it. And he's got I don't envy the job he has to do.
I'll be polite because I see Shana licking her lips, wetting her lips. Go ahead. You go ahead and talk first.
No, I'm just, it is certainly a balancing act. And, I feel for him. I mean, think about what the Fed is charged with right now. They have to raise rates gradually enough to bring prices down, but to do so without boosting unemployment. So it's a really tough job right now. And I guess my comment would be about, stagflation or recession. Stagflation this time is a bit different. I mean, the unemployment situation is wildly different than when we saw stagflation back in the 70s. So, recession possibly, but we just have to see what the data says this week, see what how he reacts to the data, and move forward. But it's a tough position for sure.
I'm going to give you a couple of positive pieces on this that I think are important. First, we are correctly focusing on what's in front of us, but I think there is also unintended consequences to what's happening right now. I'll give you a couple of thoughts. The idea of interest rates cooling the housing, that's not necessarily bad. I was on a call just before this with a civic development organization in one of our challenged neighborhoods. And one of the things they're observing is that pricing had gone up, even in a very challenged neighborhood. And now it's calmed. Even before interest rates, the demand is calming. The demand is calming in general. We're not seeing that in terms of real estate. And that's going to make purchasing easier in the future, even if interest rate goes up a bit. Now, if it goes up several percent, that's not going to be easy. The other piece I'd like to offer, and this was an opinion that was floated by Fareed Zakaria, for whom I have great respect, his intellect and analytical ability, in a syndicated op-ed piece this morning. And that is that higher energy prices are bad right now, but they are going to spur investment in alternatives that wouldn't occur if those energy prices stayed lower. So we've got to look beyond what's happening right now. And the final piece I'd like to offer is, you are absolutely right, Kim, about the government subsidies that went out. But what Congress has done is to enact infrastructure spending that argues strongly against the recession. And after all, a recession defined as 2 quarters back to back of negative GDP. It's not a depression. It doesn't mean we're all going to be selling apples to each other. It's just that the economy will slow down. So I think we shouldn't be too fearful of what we're seeing. I think what we're seeing on the international political stage is worse than what's happening economically.
All right, now I asked those questions about what you felt about a rate increase, how much of one we might see, what kind of a balancing act this might do that the Fed faces, and what might happen there. I asked those questions because I wonder what the impact of the Fed action is going to have on one's investments. In other words, is there something that investors should be doing right now in case we slip into stagflation, which you've discounted, or a recession, as Bob just discounted? So Bob, I'll stay with you, your comments.
One quick thing that should occur, as regular listeners know, one should never try to time markets. You can't time markets, but you should look at your asset allocation model and what populates the sectors of your model. And one big sector to look at relative to higher interest rates, higher inflation, would be the bond part of your portfolio. If one is invested in longer term, even longer intermediate term bonds, one could be hurt in terms of their capital value. The answer is not to go to cash, because isn't that smart? We're going to accept a 0.75% interest rate in our money market in a 7% inflationary environment. That doesn't make sense. So the answer is to populate our portfolio with the right securities. And bonds, in my mind, are more vulnerable than equities right now.
Shana.
Let me explain that. When
Okay,
interest rates go up, the value of bonds go down because they're competing with new bonds coming out at higher interest rates. So if you're stuck holding old bonds at a lower interest rate, they're going to be devalued and you'll have to hold them until maturity. And if you're in a bond fund, you don't even own the maturity.
It's very interesting. Go ahead.
No, go ahead,
Please.
Frank.
No, please.
I'll referee this. Shana, go ahead.
Hey.
You sound like that commercial on TV. No, you don't.
Here's what I'll say. To our clients that are taking income from their portfolio, it's probably a good idea to have about 3 to 6 months of cash, your monthly distributions in cash. That way you're insulated from future volatility, because we do expect the volatility was likely to continue. But generally speaking, making drastic changes now could be detrimental. I mean, what we don't know is that we're in these types of moves with the market is you never know when the market will turn. We see this, I mean, it's been fluctuating sort of like a yo-yo, right? And the market's down, market's up, and it could swing for the upside at any moment. So again, back to the comment that Bob made, just making sure that you have a diversified portfolio, just don't do anything drastic at this point.
That cash reserve is an important component that I think we all use with our clients. And that
Yep.
if people can see that in their mind's eye, it gets you through the interim volatility. You don't have to
Right.
worry about it because you're not liquidating in a downturn.
Mhm.
Frank.
Without recommending anything in particular, there are categories of fixed income vehicles that float. There are bank loan funds, for example, that they're a little higher risk, so you have to be careful, but they have floating rate instruments in them. There are also very conservative investments called Treasury inflation protection securities, which give you virtually zero interest plus the inflation rate, which is material these days. And these fixed income investments, if you could straddle the two, you would have some upside in income from the floating rate securities. And if this is as high as inflation is going to get, let's hope, you would have that fixed rate of return at least until inflation starts going down sometime in the future. But your principal risk would be nominal.
And something you and I did during the last inflationary surge, Frank, when we both were young, is staggered maturity short to intermediate term bonds.
Right.
You're building your own flexibility and you do own the maturity of those bonds.
We've been using what's called kicker bonds, which are longer maturities with short-term calls, so that you can pretty much assure yourself if rates don't go up too much that your bonds will be called away, but you can get the higher cash flow in the interim. You're going to lose some principal on that because you'll pay a premium for those bonds, but it's mathematically favorable compared to par-based bonds.
Better be a sophisticated investor to become.
I was just going to say that's
or hire sophisticated people to work for you.
exactly true. That's true as well. Kim, let's go to you.
Sure. So I'm the equity person. And what I'd say if you're running your own portfolio is to make sure you have really high quality companies with great balance sheets during this time. Don't do a GameStop. Okay. Just don't. Walk away from those speculative names and concentrate on real companies with real cash flows and real balance sheets. So that's what I think you need to do in inflationary times.
All right. Now, you all have kind of touched on this in your last comments here, but in our previous programs, everyone said you should not go to cash. You're reiterating that once again. The NASDAQ, though, could be considered. I don't know what it's doing necessarily at this moment, but after the close on Friday, it could be considered in a bear market. It's down 20% from its recent highs. The Dow is down 10% as of Friday's close. It's up a little bit today. The S&P 500 is down around 12%. So given what you've all just said a moment ago, is this a time to be cautious or aggressive? You've said, have some cash available, ready to go in. Is this the time to do it?
So
And
Stacy, one quick point about, we keep talking about don't go to cash. I just want to reiterate why it's so important not to go to cash is because that we never know when to get back in, right? So that's really the challenge here. But in the case of your question, it's really that one size does not fit all. What might be good for one investor might not be good for another, meaning that an older investor relying on their portfolio for income should be a bit cautious right now. But a 30-year-old investor who would have no reason to be cautious and should be thinking about ways to add money to their portfolio, assuming that you have your liquidity, your 3 to 6 months of cash on the sidelines, now is a great time to jump in. And it's a buying opportunity, as Kim likes to remind us. And we all like buying something on sale, or at least I do. So Kim will, I'm sure, share with us today that there are a lot of good companies out there with depressed prices, but still have good cash flow, balance sheets, et cetera. So I'm more excited right now for those younger investors that can put some money to work right now.
The choice isn't just, and agreeing with Shana, the choice isn't get out of emerging markets or small caps and go to cash. That's where the reallocation comes in. You stay invested, but you can go to, as Kim said, the larger capitalization, the less volatile, larger companies. So it's not getting out. It's simply reallocating to, as Shana said, a risk tolerance level that suits you.
Mm.
But this is the time to own, and if you can afford to, buy rather than sell.
There's an interesting bifurcation going on in the marketplace today where you have certain industries like technology, which are just getting taken out behind the woodshed and width. And you have other industries like energy, which personally, I think from a long-term perspective are living on a melting iceberg, and that are running rampant because there's a shortage of energy right now. As Bob said earlier, this may be an opportunity with these high prices to transition more towards more green things. And if that in fact happens, the energy prices probably will peak out somewhere in here, and so will those stocks if they haven't already. And so as you reposition, you might take a look at what's really been doing well, and remember Aesop's tale about the race. The plodding turtle, in fact, won the race. The hare who rushed ahead, like GameStop, Kim, was sleeping when the turtle crossed the finish line.
Geographic region plays into that thought too. For example, we're lightening up our commitment to Europe because they will likely have a greater effect, lingering effect of the war that's going on now and the energy disruption. That doesn't mean we're going to take that money out and go to cash. We're going to put it in a more stable situation.
I thought when you said geographic, I thought you were going to say it was a tougher for the turtle to go up a hill as opposed to the hare.
That's physics. That's physics. And just for the record, Frank and I don't run anymore. We fly.
Yeah. Being more like the turtle, I'm forced into that approach.
Kim, your quick thoughts.
I just think there's so much opportunity out there, and especially in the tech wreck right now. Now, I've always said this, my entire career that started, well, in this career, 99, look at productive tech that actually adds value to corporations as opposed to Facebook that is a time suck and, makes you less productive. I'm being funny about it, but that's true. So looking at our demographics, looking at longer range kind of investing, 3 to 5, maybe even 10 years out, that I can see productive technology as the way that we're going to be able to maintain our lifestyle, bring up the rest of the world to a better lifestyle, and to be able to do this with less people, because it certainly doesn't look like there's a huge amount of growth going on in the population places of the world. So technology is going to be a winner. And I think it's a very fertile field right now, but you have to stay away from the non-productive uses of tech and really think hard and long about where this company is going, who would be the buyers, and who would pay up for that product. And I think if you do that and use your imagination and do a whole lot of research, you can find some really great companies out there that are long-term technology plays that are going to improve the world and improve your portfolio.
I don't want to spend much time on this, but a lot of people who do watch this program are not necessarily individual investors. They're in 401ks, they're in IRAs. In the past, Shana, you mentioned this as well, that there are targeted funds. Is it best for someone who has a 401k or an IRA through their companies to be in those targeted funds at this moment? And Shane, I'll start with you. Quick.
I think, Stacy, they're a suitable recommendation if you don't have anybody helping to build your asset allocation. But here, as we work with clients and do look at their 401ks, We choose to have a lot more hands-on, and to Bob's point about international is a really important one. And we've made a choice back in 2020 to have a very insignificant amount to international based on COVID and now what we're hearing with Russia and Ukraine. So that's where that would give you a little opportunity to do some more hands-on diversification outside of the target date. That way you can reduce your international exposure through this. But generally speaking, a target date for the average investor, it's not a bad choice. Over the long term, these markets will recover as they always do.
All right, I'm going to assume that most of you are going to agree with what Shane has said. Bob, we've wanted to talk about taxes for some time. It's on your mind. So what are you telling your clients this tax season?
And every tax season and all through the year. And this is a topic, as we've discussed, for a future show, but I'll lay in a teaser so that we know what we're heading toward. You asked a question a little bit earlier about a downturn in NASDAQ stocks of 20%. Well, for most of the people listening to this show, their top tax bracket is at least 25%, and for some pushing 40%. So if you're not doing tax-wise investing with your portfolio, you can be giving away 25 to 40% and not the market volatility if you're not wise about how you allocate and manage your portfolio to minimize the impact of taxes. So we're going to do that on a future show, right?
Yes, we'll get into that. I want to say again, thank you to all of you for joining us today. And it's that time of the day when we like to say thank you to all of you and then switch over to Kim. And there is a reason for that. Kim has been with us for some time here, and she's been suggesting some stocks. Now, before we hear from Kim, I do want to stress that under the rules and the regulations of the SEC, that Frank and Bob and Shana are not allowed to state publicly any stock picks, and that anything that Kim touts is her suggestion and only her suggestion. Having said that, Kim, you have 9 active selections right now. By my calculations, 2 of the 9 stocks are higher than when you chose them. 7 are lower, reflecting what's happening in the market. Overall, what I like to call Kim's around the table portfolio is down just a little more than 6%. So what are you suggesting this week, Kim?
Well, this is for people that may have a longer time horizon and certainly can have sustain more risk. I'm going to talk about a local company. It's a relatively small company when you're looking at things like Apple or Microsoft. This is not in that same category at all. It's a very small company, so that means higher risk. And I've drawn this out long enough. Take a look at 26 Incorporated. The ticker symbol is IIVI. They were based in Saxonburg. I think they're up in Wexford now, but they are a company that has very high-tech materials that are used in optical networking sort of applications, defense contracting, and they used to grow, and they still do grow, the crystals for industrial lasers, for cutting steel. It's a very well-run company. They're doing an acquisition, which has taken far longer than anybody anticipated, and it's moving them into creating an entire laser platform as opposed to just providing pieces of it. And again, this is a riskier pick, so make sure that you understand that and make sure that I am not recommending this in any way, shape, or form. It's for you to do your homework on, but we like 26. It has that Pittsburgh touch, and it's very high tech.
All right. We have about a minute left here, Kim. You mentioned that there are tech stocks that people should be taking a look at, and some tech stocks that they should not. So this falls into one of those categories where you say, how is it going to help other companies as such, as opposed to, I'm going to say, social media, maybe?
Exactly. I mean, a lot of their products are used, just to get this thing out over the internet, our video out over the internet. So they have a lot of components for 5G, for connecting cities with the internet, the big optical connections, and a lot of their products are bought by companies, not necessarily used by consumers. And that's kind of the breakdown that I see, is less things that you would use or buy as a consumer and more things that companies would buy. That's what makes productive versus consumer, right? Or
Right.
fun.
Okay.
So those are the kind of companies I've traditionally done well on because they have a value orientation. They have to provide good value for their customers, not just entertain and delight them.
All right, Kim, thank you. And I also want to thank all of you for joining us once again. That would, of course, be Kim and Shana and Frank and Bob. And thank you for joining us and joining me. And I hope that you join us again for the next edition of Around the Table with Stacy Smith.